The topic for this video is Module 5, Industry Structure, Chapter 13, Structure of the Investment Industry, for the CFA Institute Investment Foundations Program. So here we are starting Module 5, Industry Structure. The topic for this video is Chapter 13, Structure of the Investment Industry. There are 9 learning outcome statements for this chapter. And as you can see, there are 28 questions in the learning ecosystem. So the next 2 chapters are not so difficult and not so heavily weighted in terms of chapter practice questions, although you can see that the module still is making up for 20% of the exam. So across these 3 chapters are 24 questions on the exam is what you would anticipate. So if they're equally weighted, it's not that it's going to be, but you could estimate that there would be 8 questions per chapter. And sometimes that's the way that I like to look at it. You can't game the exam, but sometimes you can anticipate and concentrate your efforts. So it's a bit surprising because there's not so many practice questions, and yet there are quite a few exam questions based on the weighting. So that's just something to be a little bit aware of. So the learning outcome statements for this chapter are: Learning Outcome Statement A, describe needs served by the investment industry. B, describe financial planning services. C, describe investment management services. D, describe investment information services. E, describe trading services. F, compare the roles of brokers and dealers. G, distinguish between buy-side and sell-side firms in the investment industry. H, distinguish between front, middle, and back office functions in the investment industry. And finally, I, identify positions and responsibilities within firms in the investment industry. Learning Outcome Statement A is describe needs served by the investment industry. So this is coming in under Section 2 of the chapter, how the investment industry promotes successful investing. Okay? So the investment industry provides services to those who have money to invest, individual and institutional investors who become providers of capital. Investing involves many activities that most individual and institutional investors cannot do themselves. Investors must, 1, determine their financial goals, in particular how much money they will need to invest for future uses and how much money they can withdraw over time. Number 2, investors have to identify potential investments. Number 3, investors have to evaluate the risk and return prospects of potential investments, and we've seen some of that in quantitative concepts chapter and in the chapter on equities and on the chapter of debt as well. Okay. Number 4, investors have to trade investment securities and assets. That's part of building and maintaining a portfolio. Number 5, investors have to hold, manage, and account for investment securities and assets. And then finally, investors have to evaluate the performance of their investments. So these activities generally require information, expertise, and systems that few individual and institutional investors have. So investors can obtain assistance with these activities from investment professionals, either directly by hiring investment professionals or indirectly by investing in investment vehicles that the investment industry creates and oversees. And we've seen some of those vehicles in the previous chapter, such as mutual funds or exchange-traded funds. Learning Outcome Statement B is describe financial planning services. So as you'll note from the front slides, I'm also a holder of the Certified Financial Planner designation as well, in addition to my CFA. Okay, and I've taught the CFP program in continuing education at college in Canada back in 2009-2010. So I do have some insights on this area. Okay. Anyhow, this slide is looking at financial planning services. Investment clients often need advice to set their financial goals and determine how much money they should save for future expenses. Okay, so that's a key point. Some clients also need advice about how much money they can spend on current expenses while still preserving their capital. Financial planners help their clients understand 1, their current and future financial needs, 2, the risks that they face when investing, 3, the ability to tolerate investment risks. And when we look at risk, we look at the ability to take on risk, and then we also look at willingness, okay? We're not seeing that in big detail in this chapter, but that's a very important topic that runs throughout portfolio management in the CFA program, is that when you talk about, we've looked at risks of different asset classes in the previous chapters, but when we look at the ability to tolerate risks by investors, we break it up into two categories. One is the ability to take on risk. That would be how much money you have, what are your commitments if you're looking at an individual or family, the size of your income, your other assets. But then we also look at willingness to take on risk, and that's personality. So some people have a very big willingness to take on risk, but they don't have the ability, so they shouldn't be taking a lot of risk. And there's a lot of people perhaps that have are risk averse, but with a bit of education, they have the ability to take on risk and maybe get higher returns. Okay, so sometimes there's a mismatch between ability and willingness to take on risk. And so anyhow, I'm just throwing that in here right now. That's a nice to know, not a need to know versus the chapter, but it's an important concept because we've talked a lot about risk on the standard deviation and variance side, but we didn't talk about risk from the investor side. Okay, so the financial planners help their clients understand their ability to take on and willingness to take on risks. Okay, so finally, number 4, financial planners help clients with their preference for capital preservation versus capital growth, and that's where we're talking about the objectives. Okay, the objectives of the investor. Is it capital preservation or is it capital growth? Remember here we had the returns and we had the risk as measured by standard deviation, and we had the different portfolios. RBC had the 6 portfolios. Up here was capital growth, but as we know in the short term, that's it could have negative returns. Okay, the higher risk, the higher return, and so financial planners help their clients understand their objectives. Do you want capital gains with higher risk, or are you conservative and you want to protect the value of the portfolio with very low volatility? So invest more in bonds, less in stocks. Over here, more in stocks, less in bonds. Learning Outcome Statement C is describe investment management services. And here we're looking at services for high net worth and institutional clients. So some high net worth and institutional clients rely on investment professionals to take care of the entire investment process, from identifying potential investments to implementing the investments and evaluating their performance. Others use the services of investment professionals selectively. Many investment professionals receive authority from their clients to trade securities and assets on their behalf. That's what we call discretionary authority. Those who have such discretionary authority are often called investment managers or asset managers, sometimes called portfolio managers as well. So depending on the context, these terms may refer to the individuals who make the investment decisions or to the investment firms for which they work. So continue with the investment management services. Now we're going to look at investment management activities. So once individual and institutional investors have determined their financial goals, they need to implement their savings and investment plans to be able to achieve these goals. Investors often require investment management services to do so. So investment management activities include asset allocation. That's the proportion of a portfolio that should be invested in various asset classes to help meet financial goals. And I've shown examples of a core portfolio made up of stocks, bonds, and cash. The asset allocation is the percentage that you place in equities versus in debt, for example. Okay, so we should be familiar with that. Investment analysis is another investment management activity, and that involves estimating the fundamental value of potential investments and identifying attractive securities and assets. An investment's fundamental value, also called intrinsic value, indicates the price that investors would pay for the investment if they had a complete understanding of the investment's characteristics. And we saw that in the chapter on equities, the dividend discount model. We're trying to estimate the stock's intrinsic value, and we can compare that to the market value, make a determination if the stock is undervalued, overvalued, or fairly valued. Okay, we don't get into it in such great detail there, but that's what investment analysis is basically trying to do: come up with an intrinsic value compared against the market value and make a buy, sell, or hold decision. Okay, another investment management activity is portfolio construction, which requires investment managers to invest in the attractive securities and assets they identified through their investment analysis, taking into account the client's requirements and appropriate asset allocation. Okay, this is my own slide from some CFA curriculum with regards to the portfolio management process, and it's a good time. This is a nice to know, not a need to know, but it really complements describing the investment management services. Okay, so here you can see the portfolio management process. Step number 1, discover risk and return profile of the investor and the philosophy. Number 2, determine the investor objectives and constraints, and the objectives would be the return objectives, preservation of capital or growth or income. And then in terms of the constraints, it's always LLTTU, which is legal constraints, liquidity constraints, time constraints, tax constraints, and any other unique circumstances. Number 3 is establish a geographic focus. Number 4, developed an asset allocation mix strategy. That would be the strategic asset allocation. That's if we have a pie, how much is put to stocks, how much is put to bonds, how much is put to cash, how much is put to alternative investments. That's the strategic asset allocation strategy. Number 5 is develop an investment policy statement, IPS. We're not going to get into that in detail here, but that's just basically, it's not a contract, but it's laying out all this information throughout this process. Number 6 is implement the asset mix, and this is what we're talking about in this chapter, part of the investment management services. Number 7 is monitor the investment universe and the investor, because investors change over time in terms of their risk and return profiles. And then finally, number 8 is the ongoing and continuous evaluation and communication of the portfolio performance. Okay, this slide's going to be looking at passive versus active investment management. I just want to say, kind of my own opinion is that passive versus active investment management is really, that's your investment management philosophy. And there's no right way to invest or wrong way to invest, but there are definitely different ways of investing. And 2 different ways of investing is either through a passive approach or an active approach, and they're different approaches, they're different philosophies, okay? And this is what we're going to look at in a little bit more detail here. And sometimes it's a bit of a combination of both to varying degrees. But anyhow, passive investment managers seek to match the return and risk of an appropriate benchmark. So if your benchmark was the S&P 500, a passive management approach would be investing in a exchange-traded fund that is meant to replicate the benchmark, and you'll be happy with how the benchmark does. When it's up, you're up. When the benchmark's down, you're down by the same amount. You're not paying any management fees, okay? So benchmarks, that's the S&P 500 as an example as a benchmark. But benchmarks can include broad market indices that cover an entire asset class, indices for a specific industry, and benchmarks that are customized to the needs of a specific client. That's if it's a very big institutional client. Passive investment strategies are the least costly strategies to implement because they involve buying and holding securities based only on their characteristics rather than on analysis of their future return prospects. And that's why when we see exchange-traded funds, their management fees are very low compared to actively managed mutual funds that are trying to outperform their benchmark indexes, okay? So moving on to active investment managers, they try to predict which securities and assets will outperform or underperform comparable securities and assets. So there's two things when you talk about active management. There's active security selection, but there's also active market timing, okay? So active investment managers are sometimes trying to time the market, buy low, sell high, and predicting the market's peaking. So they'll lighten up on their allocations. But that it's a lot of academic research showing that it's very hard to time the market. But nevertheless, active investment management does involve market timing. But it's also the security selection. So it could be at the macro country level or the industry level or down to the individual company level, and creating concentrated portfolios that, because they're different than their benchmark, have the opportunity to outperform or sometimes underperform the benchmark. That's why they're different. The performance versus the benchmark is different because they're under and overweighting versus the benchmark. Okay, active investment strategies are more expensive than passive investment strategies because they obviously require greater resources. So investment clients hire active investment managers only when they believe that these managers have the skill to outperform the market after taking into consideration all the fees and commissions. Fees and commissions are negative performance. So this is my own slide. It's nice to know, not a need to know, a little bit outside the Foundation's curriculum, and the source is from Credit Suisse, 2013, and it's looking at strategic versus tactical asset allocation. So again, we're talking about these investment strategies, different ways of investing. So over here on the left-hand side, we've got strategic asset allocation. The goal is definition of the optimal long-term investment strategy, that's 5 to 10 years. And the assumption is that markets are efficient and assets are fair value. So the application is define the benchmark, okay, and perhaps replicate it. And the required input is long-term risk and return assumptions. Over here on the right-hand side, though, we're looking at tactical asset allocation, which is taking advantage of short to medium-term opportunities, 0 to 3 years. And the assumption is that markets are inefficient. You calculate that intrinsic value. It's different than the market value. The market hasn't been efficient in the pricing. You've made the better analysis, and those assets come to your fair price. That's the assumption, is that markets are inefficient. Not all assets are at their fair value. So the application is active management. That's doing the security analysis and finding these differences in your from your analysis. And the required input is the models to identify misvaluation of assets. And that's what the whole CFA Institute Research Challenge is all about. It's coming up with a company valuation, and the recommendation buy, sell, or hold. Your recommendation to buy is if your intrinsic value is below the market value. Your decision to sell would be if your intrinsic value from your analysis came up with a price that's higher, and if it's in the fair range. Okay. So now we're moving on and looking at services for retail clients. Retail clients are families and individuals in general. Okay. Retail investor, the difference is retail versus institutional. So retail institutions, pension funds, sovereign wealth funds, insurance companies, banks, governments. Retail investors typically we're referring to families and individuals. Okay, so retail investors do not typically have access to the same level of service as high net worth and institutional investors. So many retail clients obtain assistance and advice on investment management activities, including asset allocation, investment analysis, and portfolio construction from investment professionals who work for financial institutions or brokers, from investment advisors or certified financial planners, for example. Some investment professionals receive commissions from the firms that sell mutual funds and life insurance policies for the trades and contracts they recommend. Others are fee-only professionals, such as a lot of certified financial planning models are fee-only, and they only accept payments from their clients based on the services that they're providing. Unlike brokers and agents who are paid commissions on the trades and contracts they recommend, fee-only professionals do not have incentives to generate commissions by recommending specific products or excessive trades. Learning outcome statement D is describe investment information services. Okay, this slide's looking at investment research providers, but before we look at more detail on that, just going to start with the bigger overview is that many investors and investment managers obtain investment research, financial data, and consultancy services from firms that specialize in providing these services. These companies include investment research providers, which we're looking at on this slide, but then we're also going to be looking at credit rating agencies, financial news services, financial data vendors, and investment consultants. Okay, so on this slide, though, we're looking at investment research providers, and many investors use research reports when making investment decisions. These reports often help them gain deeper insight into the risk and return prospects of potential investments. The firms that provide investment research assemble information and opinions that most investors cannot easily produce themselves. So to produce the research, these companies employ data collectors, financial reporters, and expert analysts. Investment research reports can be particularly valuable when they are written by industry experts who understand the financial implications of new industrial technologies, for example, for example, the fracking technologies that oil and gas drillers now increasingly use to extract hydrocarbons. So most investment reports are largely based on publicly available information, but they're experts in accumulating it and analyzing it. These reports summarize information from lengthy disclosures, saving investors considerable time. Many reports also present financial analysis that estimate the fundamental value of the securities, the intrinsic value of the securities. Investors often get research report from their brokers who purchase research reports or produce them internally in their research departments. So brokers give research to their clients to better serve them, to attract new clients, and to encourage their clients to trade. Investors may also purchase reports directly from independent research companies, or they may obtain reports from research companies that issuers pay to produce investment reports about their securities. Moving on now to credit rating agencies. Credit rating agencies specialize in providing opinions about the credit quality of bonds and their issuers. So credit ratings are looking at debt securities, in general bonds. High bond credit rating indicates that the credit rating agency believes that the issuer, for example, a company, has a high probability of making all future payments of principal and interest when due. And we saw that on the chapter for debt. The difference between investment grade and non-investment grade or high yield or junk bonds. Okay, so credit ratings agent, remember the triple B is the bottom for the investment grade. We've looked at this in the debt chapter a little bit, so we're coming back to it here. They're considered to be a information services provider. Most rating agencies do not charge investors for the ratings, although they may charge them for the detailed reports on which the ratings are based. Instead, this is important to understand, corporate issuers pay rating agencies to rate their securities because ratings generally make securities more marketable. That's a key important point, is that corporate issuers pay the rating agencies. An obvious conflict of interest thus arises between issuers are likely to direct their business to those agencies that will provide them with high ratings. But credit ratings should recognize that if they lose their independence, investors may no longer respect their ratings. So this slide is moving on to financial data vendors. To invest and trade successfully, most investors need current and accurate data about companies and market conditions. Okay, many data vendors provide such data, including the following. Number one is macroeconomic data information about economic activity and international trade. Number 2 is accounting data information about a company's financial statements, including the balance sheet, income statement, and cash flow statement. Now we can get, if it's publicly traded companies, we can get the accounting data from annual reports or some from public websites. But the power of these financial data vendors is that the data is in formats that Excel downloads with powerful analytical tools built in already. You can look at different growth rates and they'll come up with different valuations. So a lot of the hardcore analysis that might have been done by an individual in Excel is now built into these data vending systems, and it's quite powerful for analysts. But you have to pay for it; it's expensive. And finally, financial data vendors have historical market data information about past market prices and trading volumes. And finally, financial data vendors also provide news feeds. They provide real-time news about companies and markets that investors need to know, because such news may affect the value of the company's securities. And market data feeds provide real-time information about market quotes and orders, as well as recent trades, and that's helpful to investors who want to trade. Now, the three big companies that come to mind when you talk about financial data vendors that come to my mind would be FactSet, Bloomberg, and Thomson Reuters. Now we're moving on to Learning Outcome Statement E, describe trading services, and Learning Outcome Statement F, compare the roles of brokers and dealers. Brokers, dealers, clearinghouses, settlement agents, custodians, and depositories provide various services that facilitate investment by helping buyers and sellers of securities and investment assets to arrange trades with each other and by holding assets for clients. So this slide, we're going to be looking at brokers. Brokerage services are provided to clients who want to buy and sell securities. They include not only execution services, that is, processing orders on behalf of clients, but also investment advice and research. Brokers provide many different trading services. Brokers find sellers for their clients who want to buy and buyers for their clients who want to sell. For highly liquid securities, the search usually involves only routing, directing a client's order to an exchange or to a dealer. Exchanges arrange trades by matching buy and sell orders. For complex trades, such as real estate transactions, for which effective negotiation is essential to successful investment, brokers often serve as professional negotiators. Clients pay commissions to their brokers for arranging their trades. The commissions vary widely, but typically depend on the value or quantity traded. Brokers often also ensure that their clients settle their trades. So a couple of terms here. Block brokers help investors who want to trade large blocks of securities by finding a counterparty willing to buy or sell a large number of securities. So they're sold in big blocks. Remember, a board lot is 100 shares, but a block is made up of many board lots. Okay, so we call it a block trade, which would be a large order. So block brokers help investors who want to trade large blocks. Prime brokerage refers to a bundle of services that brokers provide to some of their clients, usually investment professionals engaged in trading. So now we're moving on to dealers. Dealers make it possible for their clients to trade without having to wait to find a counterparty. They're ready to buy from clients who want to sell and to sell to clients who want to buy. So that's a big difference between a dealer and a broker. A dealer can act as a principal in a trade, okay? So dealers thus participate in their clients' trades, in contrast to brokers who do not trade with their clients but only arrange trades on behalf of their clients. Dealers profit when they can buy securities for less than they sell them. That is, when the price at which they buy securities, called the bid price, is lower than the price at which they can sell them, called the ask price or offer price. Dealers provide liquidity to their clients by allowing them to buy and sell when they want to trade. So that's a very big important point, is that dealers provide liquidity because they're trading out of their principal accounts. In effect, dealers match buyers and sellers who want to trade the same instrument at different times and are thus unable to trade directly with each other. Dealers are often called market makers, which is an important term, because they are willing to make a market, that is, trade on demand, in specified securities at their bid and ask prices. Brokers and dealers face a conflict of interest with respect to how they fill the client's orders. When acting as brokers, they must seek the best price for their clients' orders. When acting as dealers, however, they profit most when they sell to their clients at high prices or buy from their clients at low prices. Finally, primary dealers are dealers with which central banks trade when conducting monetary policy. So we saw that monetary policy back in the macroeconomics chapter. So when the central banks are conducting their monetary policy, they're dealing with primary dealers. Okay, so for example, central banks may sell bonds to primary dealers to decrease the money supply. The primary dealers then sell the bonds to their clients. Now we're moving on to clearinghouses and settlement agents. Clearinghouses and settlement agents settle trades after they have been arranged. Clearing refers to all activities that occur from the arrangement of the trade to its settlement. Settlement consists of the final exchange of cash for securities. Clearinghouses arrange for the final settlement of trades. Reliable settlement of all trades promotes liquidity because it reassures investors that their trades will be settled and thus allows strangers to confidently contract with each other without worrying much about the settlement risk, which is the risk that the counterparties will not settle their trades. So remember, on the chapter on derivatives, one of the advantages of the future exchanges is that they require investors to post margin with regards to their trading activities, and then daily the prices are marked to market, and then there could be margin calls, and so more cash has to be placed in the account or the security will be sold. And so the clearinghouses are reducing or eliminating completely the settlement risk, okay, the counterparty risk, and that, of course, helps to promote confidence in the market and promotes liquidity, of course. And finally, in this section, we're looking at custodians and depositories. Custodians are typically banks and brokerage firms that hold money and securities for safekeeping on behalf of their clients. Security ownership records were once commonly held as actual paper certificates in secure vaults. Now securities are almost exclusively held in book entry form as secure computer records. Custodians may also offer other services for their clients, including trade settlement and collection of interest and dividends. The fees they charge their clients often depend on the type of services they provide to them. Depositories act not only as custodians, but also as monitors. They are often regulated, and their role is to help, number one, prevent the loss of securities and payments through fraud, deficient oversight, or natural disaster. Number two, encourage that securities cannot be pledged more than once by the same borrower as collateral for loans. And number three, ensure that securities said to be purchased are actually purchased. Having reputable third-party custodians and depositories holding assets managed by an investment manager helps prevent investment fraud, such as Ponzi schemes. Now, that was the big issue with regards to Bernie Madoff. It's that when he was providing statements to his clients, they were statements that was made by his firm, okay? And it showed investments going up. Clients would receive those payments, those statements. They thought, hey, this looks great. But they never asked the question, who's the custodian? Where are these assets being held? Can I check with it? How the statement is coming on Bernie Madoff letterhead saying my account has gone up. The question that should have been asked is, where is the custodian? Okay, where are my assets being held? So a quick practice question from the learning ecosystem to check our understanding on that section. This is classified at the difficult level. And the question is, which of the following statements is most accurate? Dealers A, match buyers and sellers, B, serve as trade negotiators, or C, provide liquidity in securities markets? So the correct answer is C, dealers provide liquidity in securities markets by trading on demand. That is, they buy when their clients want to sell, and they sell when their clients want to buy. So they're providing liquidity. A and B are both incorrect because matching buyers and sellers and serving as trade negotiators are services provided by brokers, not by dealers. Learning outcome statement G is distinguished between buy-side and sell-side firms in the investment industry. So this is really important to understand. You often hear buy-side, sell-side. Are you on the buy side or the sell side? When I was young and didn't understand that, I thought I'm on the buy low, sell high side. I didn't really ever understand what the buy side and sell side was. So this is important to pay attention. Practitioners classify many firms in the investment industry by whether they are on the sell side or the buy side. So sell side firms are the investment banks, the brokers, and the dealers. They primarily provide transaction services and investment products. They're selling products to the buy side. Buy side firms are the investment managers, the pension plans, endowment funds, foundations, sovereign wealth funds, and insurance companies. They purchase these services and products from the sell side. In addition, the buy-side, sell-side classification is somewhat arbitrary and not easily applied to many large integrated firms. For example, many investment banks have divisions or wholly owned subsidiaries that provide investment management services, which are buy-side. These functions are on the buy side, even though investment banks are sell-side firms. Okay, a little bit confusing. Try to keep track of it. In general, sell-side firms, investment banks, brokers, and dealers, but investment banks can also, have divisions or subsidiaries that provide the investment management services, which are buy side. So that's just a little bit something to be aware of if you see a kind of a tricky question. Learning outcome statement H is distinguished between front, middle, and back office functions in the investment industry. So again, this is important to understand the different roles and jobs in the front office, the middle office, and the back office. Okay, so here we have the front office. You can see it's the front office. It's dealing with the clients. Okay, so over here you've got the clients, you've got the front office. They're placing the orders, and the front office is placing the executions. Okay. So the front office handles the client-facing activities such as capturing and executing trades. So some of the departments would be the sales department, the marketing department, customer service department. Okay. Then with regards to processing trades, we see that the next level is the middle office. And the middle office support the front office activities by validating, booking, and confirming trades. So some of the roles and responsibilities and departments that we see in the middle office are risk management, information technology, corporate finance, portfolio management, and research. Okay, so you need to be a little bit careful when you're memorizing this. For sure, there's going to be a question asking you which role and responsibility department, where do they fit in? And so, for example, if you ask me IT, I might initially think that IT is kind of a back office function, but no, when we're looking at the investment industry, IT is considered to be middle office. So it's important to understand you basically have to make this into a cue card, and I like to make it into a list: 1, 2, 3, 4, 5. I know there's 5 roles as per this chapter, and I might then summarize it down to RM, risk management, IT, corporate finance, PM, portfolio management research, and that becomes my summarized memorization cue card. Okay, then trades move to the back office, and the back office provide administrative support by clearing and settling trades, as well as providing accounting and financial support. So it's accounting, human resources, payroll, and operations. Okay, those are all considered to be back office. Now, I started in the investment industry back in 1989, 1990, and I start after my undergraduate degree, and I started out in the back office. I started in the contracts department. And then while I was working, as you find when you start working in the investment industry, you need to continue your education. So as I'm Canadian, in 1990, I did the CSC, which is the Canadian Securities course. And then because I was working for a bank at the time, TD Greenline, which is now TD Waterhouse, I started studying the CSC while I was working, and I did the CPH, the Conducts and Practices Handbook. And when you pass those 2 exams, you can become a registered representative in Canada, which means you can become licensed, and then you move to the front office where you're providing customer service. Because TD Greenline was and is TD Waterhouse is a discount brokerage, direct investing. They're not providing any advice. They're just executing the transaction. So in a sense, I moved from the back office to the front office, the customer service, and my salary went up considerably. Not a lot, but still, for a young guy, it wasn't too bad. So you have to understand the difference between front office, middle office, and back office, and what the different roles are. Okay. So I'll just put in a quick practice question to check our understanding. It's at the easy level. Let's do an easy one. Such activities of an investment firm, such as information technology, corporate finance, and risk management, are housed in the A, back office, B, front office, or C, middle office. Okay, C is correct, and that should have been an easy one. IT, corporate finance, risk management are activities housed in the middle office of a sell-side firm. Okay, so remember, they're talking about a sell-side firm here. And so again, I just cut and pasted from the previous slide, the front office, the middle office, and the back office. The back office houses administrative and support functions, and the front office consists of client-facing activities such as sales and marketing. Okay, moving on now to Learning Outcome Statement I. Learning Outcome Statement I is identify positions and responsibilities within firms in the investment industry. So the next two slides, we're going to look at some titles and we're going to look at some responsibilities. So obviously a question on the exam would give you the responsibility and you'd have to match it up most likely or least likely, most likely with the title. Okay, so you kind of have to memorize the not only the title but also the responsibilities. And it's important to understand is that in many firms, especially smaller ones, some people can hold multiple titles. For example, the chief investment officer of many investment management companies may also be the chief executive officer. So that's important to understand. You could be a CIO/CEO, okay? Anyhow, starting then with the chief executive order, the CEO, that is the person who manages the firm. The chief financial officer is responsible for financing the firm and for financial reporting. Okay. The chief operating officer is responsible for the day-to-day management of the firm. The chief investment officer is responsible for any investment advice that the firm provides to its clients and for the investment decisions that the firm makes for itself on behalf of its clients. So that's an exciting role if you're interested in the investment industry, is to be the CIO, Chief Investment Officer, and if it's a small firm, you can be the CEO and the CIO, okay? And so you not only manage the firm, but you're also responsible for the investment advice that you provide to your clients and the investment decisions, okay? If it's a larger firm, then of course you'll find a role title of head trader, and the head trader is responsible for all trading operations. At firms that engage in proprietary trading, the head trader is also responsible for all positions, risk, and profit. Proprietary trading means trading on your own accounts, and you do that for profit. So the head trader is responsible for the positions, the risks, and the profit. Okay. The chief accountant, or sometimes known as the financial controller, and I was a finance director in my past life, not at a financial firm though, for SAP, software company. So chief accountant, financial controller, finance director, that role is responsible for the accounting and financial systems. Moving on to the next slide, we can see that we're starting here with the treasurer. The treasurer is responsible for cash management, including the investment of receipts and payment of bills. Carrying on now, the chief risk officer. So sometimes you might hear CRO, chief risk officer. That is the role that's responsible for identifying and managing the risks to which either the firm or its clients are exposed. Okay, there's a very good designation, FRM, financial risk manager. Not similar to the CFA, but different in that its emphasis is on risk management, and that would be a designation that you might need if you're interested in someday becoming the chief risk officer, the CRO. Moving on anyhow, the chief compliance officer, well, compliance is responsible for ensuring that the firm complies with all constraints placed on it by laws, regulations, exchanges, clearinghouses, and clients. And one thing to understand is that compliance is not front office, it's not middle office, it's back office. Compliance covers all the offices, front, middle, and back. So that's an important thing to understand about compliance. You're responsible for ensuring that the firm complies with the constraints, laws, regulations, exchanges, etc., and its compliance runs throughout the organization. The chief audit executive leads the internal audit department. External audit is when the auditors come in and audit your financial statements. Internal audit is responsible for providing independent assessments of the firm's operational systems, along with suggestions for improvement. Anyone who has worked in a big company for a long time should be familiar with some type of internal audit activity. Definitely, I was a finance director for 5 years in Asia for SAP. I dealt extensively with the external auditors annually, to prepare the financial statements. But on several occasions, I had the pleasure to interact with the internal audit department as they were making assessments of the firm's various operational systems. Okay. Finally, another title is General Counsel, and as you should suspect, counsel means the legal department. So the General Counsel leads the legal department, which reviews and helps to write contracts, responds to or initiates lawsuits, and interprets regulations, among many other activities that would all be involved with regards to laws and regulations. The General Counsel leads the legal department. So the previous 2 slides were looking at leadership positions within firms in the investment industry. Now we're going to look at more closer detail at investment staff and their positions and responsibilities within firms. So firms in the investment industry employ many types of investment professionals. Portfolio managers at buy-side firms make investment decisions for one or more portfolio. Buy-side, sell-side, and independent research analysts produce the investment research portfolio managers use to make decisions. They also write the research reports that some firms sell. Research assistants assist the research analysts with the collection and analysis of investment information. And finally, buy-side traders interact with sell-side firms to trade orders created by their portfolio managers. And now we're down to the final slide for this topic, and we're looking at other positions that we're going to finish up with. So sales traders at sell-side firms help arrange trades for their buy-side customers. Sales managers manage all sales for regions, products, or customer types. Salespeople identify potential clients and sell them the firm's products and services. Sales assistants provide administrative and creative support to the salespeople. And finally, client service agents and their assistants answer client questions and help clients open, close, and manage their accounts. And that's the end for the curriculum for this chapter. And that's the conclusion for this video, the topic being Module 5, Industry Structure, Chapter 13, Structure of the Investment Industry, for the CFA Institute Investment Foundations Program. Thank you.